Checking. Yep. Live. There we go. All right. Let's see here. New scene. There we go. We should be live. Let's just get a check. Oops. No, I don't want to do that. Options, all desktops. Okay. All right. Let's just check in with Nick. Good to go. And we'll get started here in 1 second. I think we are good. All right. Hey, I got a special guest in the house here. What's up, man?
Guys? What's up?
Kyle's in the house.
What's up, everybody?
All the way from Texas. Welcome, man.
Howdy. Yeah.
Howdy. As in New York, we say, "How you doing?"
Yeah.
No.
Forget about it.
He goes, we're way upstate New York, and he goes, "You guys don't have any accents." I was waiting to hear the forget about it. Shut up, Kyle.
It's funny to do accents. We get enough of it as Texans.
Says the Texas guy.
Yeah, we get enough of it. Can dish it out a bit.
My wife is from New Jersey. I'm from upstate. She says, we're so far upstate, she says we have a Canadian accent. I don't know what that means. We say couch. So anyways, let me just make sure we're good. Nick is sleeping on the job. I think we're
From New Jersey.
There we go. All right, we're good. So Kyle and family, his beautiful wife, new daughter,
Yep.
and the in-laws
All of us, yeah.
arrived 2 days ago.
Yep.
And 2 days up here, or 2 weeks up here, which is going to be great.
Yep, exactly. Just
Nice.
escaping the heat and the floods and everything. So
Oh, the floods are terrible.
yeah, it's been awful. We were at the lake on the 4th, and it was clean, and then it was the lake where all the debris flowed in, and by the next day it was just like trees and stuff all along the edge, and boil water notice. So it's going to be a big cleanup, and lots of help coming in, which is great. But yeah,
Horrible.
it was a biblical flood for sure.
Yeah, horrible. We're watching back east and just with great concern, and yeah, that's terrible. But you're safe up here.
Yep.
Maybe the only thing you got to worry about is mosquitoes.
Right.
And maybe a little bit of sunburn, but you're used to that. So we're good. So we're going to be working together. This is our first official presentation together.
Yeah.
I think so.
I think so.
Yeah.
At least in the last year.
Yeah.
Yeah.
So we're working hard on the business. Markets are quiet-ish. Obviously, we have a good presentation for you. And, you know, I'm going to hit the markets up top and, you know, basically tell you that we're in pretty good shape. Markets are consolidating up at the highs. We're watching the news flow of tariffs going across. We have a Fed meeting coming up. We have earnings season starting next week. But markets are pretty quiet, which is good because it allows us to focus on the business as well as the Trump tax bill, which Kyle did a lot of work in. So I'm going to go fast through the market stuff up top and then turn it over to Kyle on the back end. Again, it's we're a little in flux here today, so we're going to keep everything on YouTube. Just update you with what's going on. No specific client actionable stuff, specifics that we need to take to the private stream in Vimeo, which, you know, it's the summer, which summer markets tend to be like this, even though the pace of information is very fast right now with everything that's coming out of the White House and on the geopolitical stage. But markets are quiet. And, you know, again, as we get further into this routine, which I think this is the second one we've done.
Yeah.
Second one we've done, we're obviously going to be doing a lot more market and portfolio specific stuff for clients. Also, we have a couple client meetings coming up this afternoon. So sorry for the early time slot. One of which may involve Kyle and I on the golf course, but we'll see. I don't know if he
that
can
would be so unfortunate.
So anyway, but just give us a little hello if everything sounds good. Oh, hey, Kev from Lakeland, Florida. Nice. Yeah, just let us know. Sounds okay. We'll get rolling. Questions, comments, insults, jokes, everything is welcome. All right, so let me switch over out of this into default. And yeah, so we'll just try to sneak our heads in there, but that's okay. All right. So let's get moving on this. And obviously, Kyle, jump in anytime you want. But I'm going to go quick on the market stuff for everything I just said. It's fairly quiet right now. You guys know the deal here. I'm going to cover this for at least another 2-3 more weeks, and then we'll cut this out. We have shut trading analysis down, which was my business for 13 years, which led, which opened the path and paved the path, I would say, to Inside Edge. We do have a little bit of crossover for my old life, which is an active trading portfolio called Active Opps. It's one of the portfolios that we offered Inside Edge. We are utilizing third-party software called Savvy Trader, which is excellent. If you want a taste of my old active stock trading life, get the push notifications, do some videos during the week, definitely check it out. And again, this is a portfolio, one of the 5 that are open to investment from our clients at Inside Edge for extremely cheap, $300 a year. I used to charge $250 a month for services of trade analysis. Now this is $300 a year. So it's a great, really competitive offering. Again, if you're into the active stock trading.
Yeah. If you like doing everything, the trading part yourself, then this would be for you.
Yeah.
Yeah.
Yep. Exactly. Yeah. You maintain control of your account. You pull the trigger on your own. And again, we don't recommend any more than about 15% of a client's portfolio. Is that where we're settling?
Yeah.
10, 15?
5, 10, 15%. Whatever you want to be kind of set aside from your core long-term strategy, which we would recommend be like the primary thing you have in place. And then this would be like a supplement to that to kind of trade on the margins. Well
said. And then part 2, that's the lower level. And then, again, we kind of have a blend of a membership and wealth management model. Portfolio investor is you get 90% of the experience of a full wealth management client without actually transferring account control from yours to ours at Schwab. Hit us up on the email here if you want more information on that. But 90% of the wealth management experience. Okay, other important news here in Saratoga is the racetrack is open as of today, July 10th. So Saratoga Racetrack is now open. I think the family is there now.
Yep, exactly. Our Airbnb had horse racing for dummies booked, so I feel like an expert already.
I suck at horse. I'm so bad. Like my only strategy is I try to find like a favorite horse, and then I'll do an exacta box with like a middle odds, like an 8-1, 9-1, 10-1. It makes sense on paper, but it doesn't. It doesn't pay anything.
I'm not betting anything. I'm not ready to lose.
Dude,
just put it that way.
You can bet $2, and it makes it so much more fun.
Yep.
You can bet $2. My mom is in the retirement age, a very active, I jokingly say, active degenerate gambler for $2 at a time. It's that I love her, and she wins too. I try to get her to upper bets, but
I might have to mirror her bets.
She's pretty good. This is funny. So while we're running horses in Saratoga today, Kyle, take this one away.
Yeah, we had a client. He's in Spain. This is his son here who made the national Spanish national news.
It's this guy right here.
Yeah,
right?
I think it's the one with the bull in a compromising position, but he got through unscathed. So.
The client that Kyle was emailing sent him this picture. I was like, dude, ask him if we could put this picture up. And he said yes.
Yes. But honestly, props to his son. I forget his name, but props for not staying on the edge like everyone else. He's out there in the middle with the bulls. Like, that's awesome.
Oh my.
Props to him.
Oh my Lord. Anyway, so again, that was kind of the thing. We got horses running here in the upstate New York, and we got bulls running in Spain.
I would do that with like full football pads, maybe.
And do you realize the oh God, I'm such a stupid brain right now. the symbolism. There's a better word for it with the bulls running.
Exactly.
It's so symbolic, indicative of the environment, and I know there's a better word. YouTube and clients, please tell me a word I'm trying
There's definitely an analogy there, yeah.
Yeah, I'm not coming up with it. So the markets are running. So we, as I said, the S&P right here on the daily chart, we made a new all-time high in the S&P. Call it what, 3, 4, 5 bars ago, which is 3, 4, 5 days ago. We're hanging above all-time highs. We are in a new breakout market. We're hanging out here the last 4, 5, 6 days since we did the last presentation. All good news. Is there a pullback possible? Yes, very much so. And in fact, a simple technique in the markets is you see how there was a high back here in that's going to be what, 24. We tested again 25, sold off into April. Strong V-shaped recovery, which we'll talk about. It's not uncommon for the market to go back and test that pivot zone. So if we were to get a sell-off here, even to the all-time high around 6,100 in the S&P, or even down to these old highs, not a big deal, because following this crazy April, May volatility V-shaped low, it's been straight up. Like, we had a couple little hiccups here. The market is due for a pullback. Okay, and I'm not going to stress very much. I'm expecting a pullback. And if we just continue higher, all right, we're going to have to deal with a pullback at some point, but it's been straight up.
Yeah, pullbacks are healthy, especially if you look at the relative strength of the market over the past year or two. A pullback is like a sane response with how things have been good, generally speaking.
Yep. It kind of the way the markets should act is it's not 3 steps forward, 2 steps back. In this kind of market, I feel like it's 4 steps forward, maybe a step and a half back, and it reloads the chamber. It gets some selling, it shakes out the weak hands, and then the stronger hands, pullback buyers, fresh money or money who have missed this rally, any pullback, they're waiting to jump in. So, it's the back and forth. They call it the back and flow, a back and fill of markets. It's a healthy function, feature, and reality of the market. So I'm kind of hoping we get a pullback, to be honest. I never want to see our portfolios go down, but it would bring in some fresh blood of people who missed all of this. And the more I'm reading, there's a lot of people, and hedge funds included, who have missed this rally. It's pretty unbelievable.
$7 trillion in money market right now.
$7 trillion in money markets. Same conversation. Here's the NASDAQ, the NASDAQ 100. So you have a high late 24, early 25. We got just shy of it here in May, and we broke above. This is the weekly chart. Over here is the daily chart. Each bar represents 1 day. Each bar over here represents 1 week. So we just went we just kind of cut through that all-time high, hot knife through butter, really didn't respect it. So I almost hope we'd go back and kind of shake out some weakness in here. And if we get a, 3-4% pullback, 5% pullback, I really am not going to stress. It's crazy. We talked about this last week too. The net U.S. investor sentiment to U.S. stocks is still negative on the whole. So this is the spread between the bulls and bears surveyed by the AAII, which on the whole is net negative, which is crazy to me. Again, markets are at all-time highs and people are still net negative on the market. It's underinvested. It's higher in consumer inflation expectations. People are fearful for what they think is going to happen based on tariffs, coming inflation, and that's leading the reading to be negative 5%. You can see, when there's 30% more bulls than bears over the last, call it 8, 9, 10 years, that's when the market tends to be overbought. 2018, you got a spike. 2020, 21, coming out of post-COVID, market was a little overdone. It led into a sell-off. Down here is low investor sentiment, and that's what makes a bottom. We made a bottom here into April and May, but we haven't been able to climb back above the zero line as the market's at all-time highs. So we have another 30% difference between net bulls and net bears until this sentiment indicator would be considered overbought in the market to be overbought. And as Tom Lee says, it's the most hated V-shaped recovery and rally ever. And, so back to the technicals, I don't want to dwell on this as much as I'm saying I want to pull back. Looking at some of these sentiment readings from all the scary headlines out there, maybe there won't be, and maybe the market needs to rush in. We're gonna make this PDF available to everyone. So, out of the interest of time, I'm not gonna go through all of it, but just kind of for your reference, these are some of the ETFs I like to look at on the macro scene. So it's sorted by percent change year to date, and there's no mistake that the percent gains from very low levels we're seeing ex-US. So Germany is actually up 35% for the year. Mexico's up. There's the Eurozone ETF up 27%. Gold's up 26%. So there has certainly been a rotation overseas in the first 7 months of this year, as the S&P is at 6.4 year to date. And here's the S&P compared to the other sectors. But, will there continue to be a rotation overseas, longer conversation, debt quality, tariffs, divesting from the U.S.? I think that theme has sort of expended itself, and we are seeing a rotation back into the U.S. So I would not be surprised if we have this conversation at the end of 2025 that, you're going to see some of the U.S. markets start to move up as some of the international start to move down, but we'll see. So year to date, and this is, there's multiple fronts on the industrials within the U.S. leading up 14% year to date. Technology up 10.8, communications, materials. There's the NASDAQ, financials, utilities. Here's the S&P up only 6.5% year to date, which happy to say our portfolios are ahead of that.
Yep, doing well.
Yep, for now. But, again, deeper discussion, but there's a lot going on in the industrials. We have the picks and shovel build out of the AI infrastructure, power demand, defense is very big. So there's a couple forces at work within industrials. That's the sector that's been working extremely well this year. From a seasonal point of view, this is the amount of times that July has closed higher. July now is a seasonally it's the strongest month. And it's interesting, I was working through this presentation and these slides earlier. This is looking at the last 20 months, so the last 20 years. So we're talking 2006 to 2025. July is the strongest months. Percent of months, 80% we'll see July move higher. Prior to 2012, July was one of the weakest months. And I didn't really know that. Now July is one of the strongest months. So take that for what it's worth. The NASDAQ by far, 85% of months from 2006 to 25, the NASDAQ finishes higher. And we're seeing a rotation into growth. All right, geopolitics. Well, all right, so hop in anytime you want here. But the 90-day tariff, I hate to say kick the can down the road, but that is passed. That was yesterday. Letters went out to various countries. I was looking through Trump's Truth Social platform. On the whole, the tariffs that were listed in April are net lower than where they're now being posted in those letters being pushed out, with the exception of Brazil. Trump's pushing back in Brazil for some of the internal workings of the country, and then their sort of rulings against American social media companies, as well as increasing copper exports. But this was yesterday, releasing minimum 7 countries having to do a trade tomorrow, and he did post all the letters that went out. And the response so far has been favorable. I think the market is pricing that in. Again, the expectation is tariffs, ranging from 25 to 30%, are going to be inflationary in the U.S. And we have to see over the next 2 CPI reports if we actually do see an increase in inflation. Anything?
Yeah, no, that's good. It's. I think it'll be one time with the tariffs, if they are actually permanent and not still being used to make deals in the future. But if this is as bad as it gets with tariffs, then it should be a one-time deal.
Nice. So this is where inflation actually is right now. So the U.S. inflation rate, the headline rate is in purple. U.S. core, ex food and energy is in orange, and the PPI, producer price index, is in the light blue. You obviously can see the 21, 22 inflationary spike where interest rates spiked, and then they started to come off quite sharply. And we have headline, core, and producer inflation stabilizing at about 2.7, 2.6, 2.3. Fed's target is 2%. The way crude oil has come off as Iran and Israel continues to, circle around a ceasefire, commodities on the whole have been in a decline. Even with the copper tariff coming out of Brazil, copper has not moved up. Gold is up. Housing prices are coming off. There's a lot of deflationary forces or disinflationary forces that I think will continue to drive this down. Fed fund target is still 4.25, 4.5. The markets are pricing at a 72% chance of a cut in September. We shall see if that happens. No cut expected in October, and then one more cut expected in December. So the markets are pricing in 2 cuts from current level of 4.25, 4.5 down to 3.754. Do you think we cut this year?
I don't know. I think GDP is going to be the other half of things.
Okay.
With the tax, I know a lot of the tax cuts were extended and they were already there, and they were scheduled to go back to a higher rate. But putting out a stimulative bill that keeps more money in people's pockets could cause more inflation, more growth, more inflation because they're out there spending more.
I 100% agree.
Yeah. We just have to
So the
wait.
answer, what do you think?
I wouldn't be surprised if they didn't cut this year.
Yep.
Or if they did, it would be like just one, 25 bips cut.
Okay.
And
Interesting.
we've seen this every year the past 2 or 3 years where the amount of cuts projected starts at 4 or 6, and then by the end of the year we've got 1 or 2.
And I've asked, I'm talking to my old trading friends. I've asked, and I'm trying to find out the inner workings of this Fed fund futures market. It's amazing how wrong they are. How do these people make any money? Because it's constantly changing. Money is being put. I've been trading my whole career. I don't understand how this Fed fund futures backdated, these contracts work. Maybe someday.
It takes an economist brain to even start to understand in theory, but they're always projecting back to normalcy on on a straight glide path, and that's just not how things are ever going to work in reality.
No, but my point is people are actually trading futures contracts and putting money behind this. And I'm
absolutely.
I don't see anyone making any money, but whatever. That's my old trading ad. Hey, Richard, what's going on? Richard F. in L.A. Kevin, what's going on? Sounds good. Thank you, sir, in Florida. All right. Okay, so inflation moderating. Last Fed, I had to look this up. I didn't know. Last Fed rate cut was December of 24 right there. So we were 4.5, 4.75. Now 4.25, 4.5, and we'll see if we cut. And let's set Trump's truthisms aside for now. But, I'm looking at, one of the best indicator where Fed funds should be. As I said, the Fed funds is trading 4.33 right now. That's that 4.25, 4.5 range. The 2-year yield is a good indicator as to where it's going. And what I look at, it's the spread between the 2-year yield and Fed funds. And, when it gets really wide, which this is the spread down here, that was right in here where purple, which is the 2-year yield, was much higher than orange, which is where the Fed sets the policy rate. That's the 2-year yield during the inflationary spike of 22 saying, you've got to hike rates. We've got to calm this inflation down. So the 2-year yield in purple is pulling the orange up, and the Fed funds did go up because obviously in orange is where the Fed sets the rate.
Yeah.
The opposite's happening now. So purple, which is the 2-year yield, which is a liquid traded treasury futures, it's traded just like a stock, that's pricing where they think the Fed is going to put rates. It's at 3.9% yield right now. So it's about 43 basis points lower, and that's the spread right here. So 2-year is pricing in two cuts. Mm-hmm. I mean, it can drag it down for a while. It can stay down here for a long period of time. But it's also, this is about as low as the spread gets over the last, 43 years. I mean, back in the 80s, it was a different economy back then, and it was a much different market, a lot less liquidity. You can see how erratic it was back then, but it's pretty stretched. So the 2-year yield is saying we do need cuts, and we'll see if it's right or we'll see if it's wrong. Now, Trump, I like a lot of things that he does from an economic point of view, but 3 points too high. That's 300 basis points. Oh my gosh! Like, stop! Like, that's insane. If he had his way, I mean, I understand he wants to refinance a lot of debt lower. I get it.
Yeah.
And that's the big thing. There's a lot of debt, treasury debt coming up that's going to be refinanced at higher rates. It's going to cost us a ton of money. But you can't take wipe this out and reduce. I think it's 700 billion is the number. You can't do it with one foul swoop of 300 basis points cut, because the inflation that would spark, it would be out of control. It'd be like throwing gas in the fire.
Right. I mean, find me a real estate person that doesn't want lower rates.
Yeah, right.
And also, I mean, to his credit, anytime that orange line is above the 2-year, anytime the Fed rate is above the interest rate, that would be a contractionary monetary policy from the Fed.
Yep.
So they are in, to his credit, they are in kind of contractionary instead of expansionary stance as far as their rate policy goes.
Yep. Well said. Well said. All right. So we're getting off of that. Earnings season's coming up next week. So, as soon as we think things are going to quiet down a little bit as markets hang at all-time highs, we have earnings coming up. Tuesday begins, financials kick off the earnings season. We are now on the 15th, JP, BlackRock, Citi, Wells Fargo. Okay. So we're now in Q2. So we're now in the back half of 25. Holy bananas. Slow down, please. ASML, that's going to be an interesting one. Semis have been ripping lately. We're talking about sort of a reemergence in the growth trade. Semiconductors, NVIDIA, we'll talk about that. ASML, Dutch-based semiconductor, Johnson & Johnson, Goldman, Bank of America, Morgan Stanley, Progressive, Prologis. Netflix. Netflix really kicks off tech. Yeah. Interactive Brokers, American Express, really good read on the consumer. Charles Schwab, where we house our wealth management capital. 3M, Schlumberger. So good earnings week coming out next week. Analysts, where we're expecting, so the end of the day, markets follow earnings. And this is the collective analyst community expectation of, if you add up, how much money each company makes in terms of dollars, per quarter, of the S&P 500 companies, we're looking at between $60, $65, $70 collectively per quarter. So what happens is, if you call it $70 per quarter, 4 quarters, $280 per share for the year. So what analysts are expecting is this upward trajectory in earnings per share going forward. So despite the bearishness out there, analysts are looking for us to go from, current levels of $60, $58 a share, because you just go from the purple line straight up to the S&P, and then we're looking to go from 60 to 64 to 68 to $70 a share. The more earnings collectively over the 500 companies, the S&P, the higher the index should go. So you can see it's not like we're at the same level here. If we continue and start making $68, $70 a share, the S&P in orange should be up here. And that's, this is what analysts are expecting. And sometimes analysts are completely wrong. But there's a disconnect between sentiment out there, consumer expectations, inflation expectations, and where analysts see, these companies producing profits, which they very much are. NVIDIA hits, sorry for the misspelling there. NVIDIA hits a $4 trillion market capitalization. Absolutely insane. 3.99. Behind that should be Microsoft at a 3.7. In brown is going to be Amazon. Oh, I didn't change that. That's going to be 3.1. This presentation is hot off the press. Sorry, my our fact checking team had the day off.
Probably 3.4.
3.4, yeah, that sounds about right. Orange, Apple at 3.14, Amazon probably 3.4-ish, as Kyle was saying. Alphabet 2.12, and down here Meta at a 1.8 trillion, but a $4 trillion company. I can remember when Apple went to a $1 trillion market capitalization. Absolutely insane. Go ahead.
That's 4 trillion is probably 15 times the GDP of countries like Finland.
That's a good factoid. That's a good factoid.
Just to put it in relatively speaking.
And you want a good graphic? Look at last week's presentation.
Yeah,
that's hilarious.
Probably my favorite chart recently.
News this morning: Delta. Insert cheesy airline joke. Delta shares taken off here, up 13% as they reinstate 2025 prior outlook, and bookings have stabilized. This is right from CNBC. Delta expects 2025 adjusted earnings of $6.25 a share. So even though down from January forecast of more than 735, so even though they're adjusting downward the expectation for next year, the stock is responding very favorably. Expects a stronger summer travel season. And I did a thing on CNBC a couple months ago looking at like bookings holdings, and I was looking at how analysts are restating earnings, how the stock was behaving. We hold BKNG in the portfolio. That thing has been ripping. Especially consumer discretionary on the whole has been sort of lagging, but this summer travel space, especially with crude oil and gas under control as the Middle East has de-escalated, has been strong. And the fact that Delta just did this, broke above the 50 and 200-day moving average, is really pretty impressive here. So for summer travel season. So we're reporting on Q2, which would be spring. Once we get into August, September, October, which would be reporting on Q3, we'll see how that summer travel season did, especially as Saratoga is kicking off the travel season here with the track. Just a reminder, if you have not, from last week's presentation, if you haven't watched this presentation, certainly go back and watch, because the AI technology, the disinflationary, deflationary properties, increasing the operating efficiency, pushing inflation down. This presentation is linked right here. Certainly go watch. It's about 45 minutes and go watch, just talking about the how extreme the AI build out that still in the very early stages is. Just a reminder to go watch that. So I tasked Kyle to try to break down the big beautiful tax bill, which he told me he doesn't want to refer to it as, but I don't know how else do you say it?
I think that's the official name. Yeah.
So I'm gonna put this on Kyle. Yep. And you, sir.
Yeah, so
take us through it.
Yeah, we've got the Schoolhouse Rock. This is a Bill on Capitol Hill song, if y'all ever saw that. I know I watched it in school, but just wanted to put that image there to lighten up all this text and numbers I stuck in here. And if you don't want to read one by one, the main point is that this new tax law, it extended the income tax rates. So you'll continue to see those benefits both personally and just for the broad economy. This should be stimulative. More people paying less taxes. That's more money to flow through our economy, and spending, saving, everything in between. And then also the amount of updated tax strategies. There's a ton of new phase outs and credits and deductions. So really, I think it makes tax planning more important to know, am I going to, hit this income limit for about halfway down, temporary $6,000 additional deduction for seniors on the standard deduction, which is money that comes right off your tax bill. And there's breakpoints here at 75K, 150K for couples. You're going to see that a lot in here. So a lot of tax benefits, new credits, deductions, with income phase out. So, contrary to there is some element where wealthier people are going to benefit from these new laws, but there are also a lot of phase outs where if you make too much, then you don't get to enjoy that benefit. So that's where the planning comes in, planning deductions, grouping your, if you see this last bullet point, the increase in the SALT deduction for people in high tax states like New York.
Thank goodness we're in. I was really missing that.
But that's, also got to phase out less than 500K. But, these are all things that we talk through individually with clients. We can look at your tax return. We can talk with your CPA, work out a plan. We can talk through things that you can do. Like a lot of people don't know you can pay your property taxes are 20K a year. You can group them. Say you have a high income year, you can pay last year and this year in the same year and actually hit that 40,000. You can double up on your property taxes and pay them in the same year.
I didn't know that.
Yeah, things to know.
See?
Yeah,
I learned something like that's what I love about our the structure of our business. Active management portfolio on my end, trying to put down the least amount of volatility and performance as I can for all of us, and then he takes care of the planning and makes sure our clients are all. I don't know.
Yeah,
I love how the two come together.
We use the word holistic. We use the word comprehensive. I mean, that's the business structure we have. We want to be able to look at everything, soup to nuts, see what works, see what we can take advantage of for you, and then try and provide some value there. So we do have some really nice tax analysts. It'll analyze your direct tax return directly and then come back with recommendations. We use that. We might add another tax software here soon. Not to get ahead of myself, but that's something
spending more of our profits. Yeah. Thanks, Kyle.
If it saves our clients money,
that's right.
Why not?
That's right.
Yeah. So I'll let you read through these. I have 3 more slides. Tax on Social Security got reduced. If you're making less than 150K couple, 75K single. The child tax credit increased by $200. Not bad. And then this is going to be a theme that we see will be adjusted for inflation annually. Back on the last slide, the standard deduction available to everybody will now be adjusted for inflation on an annual basis. And then these numbers up here will be the starting point. But that's something that they did. They do it with a lot of government benefits, like Social Security gets adjusted for inflation. Now your tax deductions are going to be adjusted for inflation and credits.
Nice.
Estate tax, that was something. The lifetime exemption got increased, $15 million per individual, $30 million for couples. That's the amount of your estate that is able to pass on to your heirs tax-free, estate tax-free, and that will also be adjusted for inflation. That's something that used to change almost on an annual basis. One year it'd be 5 million, one year it'd be 0, one year it'd be unlimited. So this will at least give it some permanency for now until a new law maybe gets made in the future. But as far, that'd be something that would probably be hard for either party to pass to make people pay more state tax. So we're saying permanently. It could change in a law in the future, but it's permanent as far as we can see for now.
Yep.
The newborn savings account. So my daughter, Alice, born in April, she'll get $1,000 government contribution into an account that acts like a traditional IRA. So parents will be able to put in $5,000 as long as they've earned income and deduct that from their taxes. And then when they get to age of majority, then that'll become a traditional IRA. So
is there an age at which the child who's now an adult can withdraw and they pay their prevailing tax rate?
I'm pretty sure once it converts to a traditional IRA. I still need to look into all the exact details.
Okay.
But I think once it would convert into a traditional IRA, it would just be subject to those rules, which would include right now you can take out, without the 10% penalty, you take a 10% penalty for money just to spend, but they do have qualifying expenses like you can take out $10,000 for a house, your first house down payment. So, For a kid, that's a big deal.
It's a huge deal. You know, I'm going to throw you off and throw you a curveball. And again, we've been just in business mode. Obviously, we're reading through and trying to piece all this together. Did the 529 reach? Did you read anything about this? The 529 reach changed, or am I jumping ahead?
Yeah.
Sorry. Go back. I jumped.
Yeah. You're good.
Yeah.
What was your exact question though?
No, I think the what 529 money can be spent on. It was kind of expanded.
They did.
Okay.
Yeah, and that's on this next slide here.
Okay.
There is a car loan interest deduction now with an income phase out. And then for 529s, we're just talking to a new client about this, and they were wondering if 529 or custodial account or saving their money in their accounts for their kids. We're talking through the options, and the old limit for a qualified withdrawal from a 529 for elementary, secondary school, a private school, used to be 10,000. It's going up to 20,000. So anyone with kids in private schools know that's more in range of what those costs can be. More than 10. So that's a good thing. That's per child.
Interesting.
Scholarship contributions. If you gift money to the scholarship granting organizations, then it's not a deduction like a normal gift would be. It's actually a tax credit. So that's dollar for dollar. So that's a nice little thing. And if you started doing that now and did it for a decade, 2 decades, that money's really going to add up.
Nice. Very good.
As far so that was all individuals. For businesses, 100% bonus depreciation is back. R&D expensing is also immediate now, and that begins for this tax year. And then retroactively, they're giving you 1 to 2 year deduction. So not an immediate, but you can do it over time. Foreign RMD remains capitalized over 15 years. Section 179 expensing went up a lot. I know people use that a lot, so that's a big one. And then the kind of the automatic 20% deduction for small businesses.
Perfect.
Which is always good.
Which is us.
Yes, sir.
Yeah.
So I'll be looking into the bill more. These are just high level notes. There's more I couldn't fit in here. There's more I haven't learned yet.
There's so much in there.
It's gonna take a few presentations and hearing what the accountants and everyone has to say about it to really understand the full impact. But
what were you saying again? Like it's creating more job security for planners and accountants. Why is that?
It is there. I mean, all of these new phase outs and benefits that happen if you keep your income below a threshold. There's ways if you're, say, let me find one. But say you're, I can go back one more.
Mm-hmm.
Oh,
it's a little. Yeah, there you go.
If you have a car loan or multiple car loans and you're at 201,000 of income and you're a couple, and we look at your income, how much you've made for the year in December, like I like to do with clients who are more tax sensitive.
Yep.
Add up what your income's going to be for the year. If it's 203, and say you have a charity that you like to donate to, and maybe you're going to do it next year, maybe we pull that up ahead and get you under that limit so you can get the full deduction. There's little things you can do, subtle changes, stuff that you might have been planning to do anyways, but if you do it strategically, then it just creates these opportunities for you to take advantage of. Right.
And like if clients have like brokerage account, non-qualified money, and they need to take profits on positions which would up their AGI or up their reportable income, like we can put hedges in, we can do things to push that income into the next year if you're looking to take profits on a position on the active management side as well as the planning side. So
more opportunities for the CPAs and for us financial planners like me to provide value and just go through these options. Once we have a understanding of your exact situations, then we just go down the list of things that might be available to you.
Nice. Really good.
Yep.
Really good. Yep.
I think that might be all.
Okay. Yes. So yeah, all good there, but good. I think kind of in and out, as they said, sort of good market right now. There's a lot going on the macro side, but the markets are quiet. Tariffs. Everybody's on watch for exactly how these countries respond to the letters that went out. If you want to go read them, Trump posted them all on Truth Social. Earnings next week. The next Fed meeting is July 29th. Market remains at all-time highs. NVIDIA is continuing to break out. I think the growth trade is starting to rotate back in. I think the market looks really good, and we're in a seasonally very strong period, as I showed you in the last 20 years. July is the strongest month. So, what is today? Today's the 10th. So we're a third of the way through the month. It should be good. Things seem to be under control, but anything can happen on the geopolitical front. So we're watching, but we're also kind of exhaling a little bit right now, I would say.
Yeah, definitely.
Yeah.
And physical AI is here. I mean, I'm in Austin. We have robo-taxi out now.
Yeah.
I mean, I think things are going to really, on the tech side, just change a lot this year.
And everything, we didn't even touch on Elon, which I'm like, oh, God.
Yeah, that might be a whole presentation.
But Uber is now leading. And it's interesting. Uber is actually considered an industrial. I showed you industrial's the best performing sector of the year within the U.S. Uber is breaking out. And, with everything that was going on with Waymo and Uber and Google, robotaxis are real. So we'll see where Elon lands and all of his different ventures. That's a different story, as you said. But the artificial intelligence boom is real. And, there's a lot of opportunities. We're looking at increasing the concentration in some of those tech-related and the growth, as well as the dividend portfolio. It's been a good year. Internationals, as we said, with Germany and Mexico and Europe have been outperforming the first half of the U.S. of the year, but I think the U.S. might play some catch up. We didn't talk about the dollar. The dollar is at lows. That's sort of a voting machine for the, how much faith do we have in the U.S. with, our debt. But if the dollar were to bounce, money were to come back into the U.S., I think that growth trade reaccelerates, and we've got more money to make, I think, this year. If not, we'll see, and we'll take it day by day.
Yep.
Anything else?
No, that's it. I guess that's it for this week.
Good work, dude. I love having you here.
I know.
So much,
do it more often.
So much better. All right, guys, say thanks, and check us out. We're at InsideEdgeCapital.com, brand new website. As I said, we have a few membership options on the Active Opps if you want to just see what we're doing on the short-term portfolio. And then Portfolio Investor is 90% of a wealth management experience without the full getting in bed together,
Exactly.
I guess we should say. But, check us out. We're all good, and we will see you next Thursday. So thanks all.
See y'all.
See you guys. All right. Now, end stream. There we go. New software. I still forgot how to turn it off.
Yeah, it's still live.